Here is something I do not say lightly because for years the S&P 500 has been my go-to investment. It is the default advice for anyone who wants to build long-term wealth. Low cost, diversified across 500 companies, proven track record. It is the index most of us are told to put our money into and never touch. And I agree with that advice, mostly. But after watching how the market has changed over the last few years, I have started moving a significant portion of my money out of the S&P 500. And in this video, I am going to explain exactly why and what I am doing instead. Let us start with part 1, the concentration problem. When you invest in the S&P 500, you are buying 500 of the largest publicly traded companies in the United States. That sounds diversified. 500 companies is a lot. But here's what most people do not realize. Those 500 companies are not equally weighted. The largest companies make up a much bigger share of the index than the smallest ones. And right now, the 7 largest companies in the S&P 500, Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla, account for over 30% of the entire index. Let me put that in perspective. These 7 stocks represent more than a third of your investment. If you own an S&P 500 fund, you are not broadly invested across 500 companies. You are heavily concentrated in 7 tech giants. And that concentration has been growing. 5 years ago, those same 7 stocks made up around 20% of the index. Now, it is over 30. At this rate, a small group of companies is dictating the direction of the entire market. In 2023, for example, the Magnificent Seven accounted for more than 60% of the S&P 500's total return, meaning the other 493 stocks contributed less than 40% of the gains. That is not a diversified market. That is a market being carried by a handful of winners. And that is a dangerous position to be in. Part 2. The AI euphoria risk. The reason these 7 stocks have grown so much relative to everything else is not complicated. It is artificial intelligence. Over the last 2 years, the market has poured trillions of dollars into companies that are positioned to benefit from the AI boom. Nvidia, which makes the chips used to train AI models, saw its stock price increase by over 400% in just 18 months. Microsoft, Alphabet, Amazon, all of them have been racing to integrate AI into their products and services, and investors have been rewarding them for it. But here's the question that keeps me up at night. What happens if the AI boom does not deliver as quickly or as profitably as the market expects? I am not saying AI is a bubble that is about to burst. AI is a genuinely transformative technology. But the stock market is not just betting on AI being transformative. It is betting that AI will generate enormous profits very quickly for a very specific group of companies, and that those profits will justify the valuations we are seeing today. And that is a much riskier bet. We have seen this pattern before. In the late 1990s, the dot-com boom drove technology stocks to astronomical valuations. Everyone believed the internet would change everything. And they were right. The internet did change everything. But that did not stop the Nasdaq from losing nearly 80% of its value between 2000 and 2002. The technology was real. The hype was real. But the prices had gotten so far ahead of reality that even a successful outcome could not justify them. The same thing could happen with AI. If investor expectations cool, if regulation slows things down, if the profit margins turn out to be thinner than expected, the stocks that have benefited most from the AI rally could fall hard. And because those stocks make up such a large part of the S&P 500, the entire index would fall with them. Part 3. Why diversification matters more than most people think. When people hear that the S&P 500 is concentrated, their first reaction is usually, well, it has always been concentrated in the biggest companies. And that is true. In every era, the largest companies have represented a bigger share of the index. In the 1980s, it was oil and consumer goods. In the 2000s, it was banks and energy. In the 2010s, it was Apple and Amazon starting their climb. But here is the difference. In previous eras, the concentration was not this extreme. In the year 2000, just before the dot-com crash, the top 10 stocks made up about 22% of the S&P 500. Today, the top 7 stocks alone make up over 30%. And the reason this matters is risk management. When you are diversified across many different sectors and companies, a downturn in one area is usually offset by stability or growth in another. But when a third of your portfolio is tied up in 7 stocks that are all in the same broad sector and all exposed to the same AI narrative, that diversification breaks down. If AI optimism falters, you do not just lose money on Nvidia, you lose money on Microsoft, Amazon, Alphabet, and Meta too. And because they all move together, there is nothing in the rest of the index to catch you. The S&P 500 is supposed to be the safe option. It is the index you buy and hold forever and never worry about. But when it becomes this concentrated, it starts behaving more like a sector bet than a diversified portfolio. Part 4. What the rest of the world looks like. This is where I have been moving my money, outside of the United States. For years, I was guilty of something called home country bias. That is the tendency for investors to overweight their domestic market, simply because it is familiar. It is what you see on the news. It is what everyone talks about. It feels safe because it is what you know. But the reality is that the United States stock market, while historically strong, represents only about 60% of the global stock market. That means 40% of the world's publicly traded companies are outside the US. And those companies include some of the best businesses on the planet: European pharmaceutical companies, Japanese industrial giants, emerging market technology firms, Australian mining companies, Swiss consumer goods makers. They operate in different economies with different currencies, different interest rates, and different growth cycles. Adding them to your portfolio gives you exposure to sources of growth that have nothing to do with the AI narrative driving the S&P 500. Over the last 20 years, the US market has outperformed international markets by a wide margin. That is true, but there have also been long periods where international stocks outperformed. Between 2002 and 2007, for example, emerging market stocks tripled, while the S&P 500 barely doubled. Between 2010 and 2015, European stocks actually beat the S&P 500 in dollar terms. And in 2022, when the S&P 500 fell by 19%, international developed markets fell by less than half that. I am not saying international markets will outperform the US going forward. I do not know that, and neither does anyone else. What I am saying is that adding international exposure reduces your dependency on a single market, a single narrative, and a small group of stocks. And that is the whole point of diversification. Part 5. What I am doing instead. So let me tell you exactly what I have changed in my own portfolio. I used to have about 90% of my stock investments in the S&P 500 and 10% in international markets. Now, I have shifted to roughly 60% in the S&P 500 and 40% in a diversified mix of international, developed, and emerging market funds. I still believe strongly in the US market. I am not abandoning it. But I no longer believe that putting nearly all of my money into one index, especially one this concentrated, is the best way to manage risk over the long term. The way I think about it is this. The S&P 500 has had an incredible run, and it might continue to outperform for another 5 or 10 years. But I am investing for 30 or 40 years. And in that time frame, I want my portfolio to be resilient to anything the world throws at it. Trade wars, technological shifts, political change, currency fluctuations, sector rotations. The US will not be the dominant economic force forever. No country is. And I would rather build a portfolio that acknowledges that reality than pretend it is not coming. For anyone looking to do the same, the simplest approach is to buy a low-cost total international stock index fund or an exchange-traded fund through your brokerage. Combined with your S&P 500 or total US market fund, that gives you exposure to thousands of companies across dozens of countries with a single pair of holdings. It takes 15 minutes to set up, and you can rebalance once a year. So to summarize, I am not saying sell everything and abandon the S&P 500. I still hold it, I still believe in it, but I have reduced my reliance on it because the concentration risk today is higher than I have ever seen it. 7 stocks, one narrative, one country. That is not the diversified foundation most people think it is. And by adding international exposure, I sleep better knowing my portfolio is not tied to the fortunes of a handful of tech companies or the AI hype cycle. I invest for the long term, and the long term is more uncertain than the last 10 years have led us to believe. If this video made you think about your own portfolio in a new way, I would love to hear your take. And if you found it useful, subscribe. I post every week on money, investing, and building a financial life that is genuinely yours. I will see you in the next one.